You've been trading for years. You've mastered the indicators. You know the patterns. You can read the order flow. You have the technical skill to be profitable. Yet, you are stuck. This is the hidden stage. You are not failing because your strategy is wrong. You are failing because your strategy is inconsistent. One day, a massive win, executed perfectly. The next, you give it all back in a fit of impulsive revenge trading. You have the knowledge, but you lack the psychological structure to sustain it. It's not about the chart anymore. It's about the mirror. Your problem isn't the market analysis. Your problem is the 5 inches between your ears. The market isn't testing your strategy. It's testing your character. And the character flaw the market exploits most ruthlessly is the ego. The P&L screen is not a scorecard of your intelligence. It is a precise, real-time measure of your psychological state. Every losing trade, every blown account, every missed opportunity, it's not a failure of analysis. It's the ego demanding validation. The ego needs to be right. It needs to prove it saw the move first. It refuses to accept a small loss, preferring instead to watch the position bleed out because admitting defeat feels like a personal flaw. That is the definition of emotional volatility. The market doesn't care about your feelings. It is the ultimate impersonal mechanism designed to exploit human weakness, specifically your need for control over outcomes you cannot influence. We try to control the external world, the price action, the news, the volatility. But true control, the kind that leads to sustainable wealth, is internal. This is where the ancient wisdom of Stoicism becomes the most practical trading philosophy ever devised. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. Stoicism is not about being emotionless. It is about radical awareness and choosing your reaction to the inevitable pain of the market. It is the necessary surgery required to remove the tumor of the ego. We are going to stop fighting the market and start fighting the self. For the next 40 minutes, we are going to lay out 10 Stoic principles. These are not platitudes. They are sharp tools designed to dismantle the psychological traps you fall into every single session. If you internalize just 3 of them, your trading will fundamentally change. But before we get to the first principle, the hardest one, which forces you to confront the single greatest lie you tell yourself every day, we must first understand the concept of the premeditatio malorum. How accepting the worst-case scenario before you enter the trade is the only way to truly free your mind. That is where we start. We start then with the concept of the premeditatio malorum. The name sounds heavy, perhaps even morbid, but its application in trading is the ultimate act of mental self-defense. This principle simply means the premeditation of evils, or, put plainly, anticipating the worst possible outcome before it happens. Most traders prepare only for success. They analyze the chart, they confirm the setup, and their mind immediately leaps to the profit target. They visualize the green numbers. They calculate the maximum potential gain. This is not preparation. This is wishful thinking masked as analysis. And when the market inevitably turns against that hopeful scenario, the shock is so profound that it short-circuits their discipline. Panic floods the system. The Stoic knows that hope is a poor risk manager. The premeditatio malorum forces you to sit down and truly internalize the loss. It requires you to look at your trading plan and not just define the stop loss, but to feel the sting of it closing. You must ask, what happens if I take 5 losses in a row? What happens if this perfect setup is actually a massive liquidity trap? What happens if the market moves against me the instant I click the button? You don't panic when the fire alarm rings if you've practiced the exit route 100 times. Why do you panic when the red bar flashes? Because you have not inoculated your mind against the pain. You have treated the loss as a surprise attack, when in reality, the loss is always a statistical probability embedded in the entry. When you practice the worst-case scenario, when you mentally rehearse the stop-out, when you accept the drawdown as a necessary, temporary cost of doing business, you strip the actual event of its emotional power. When the trade hits the stop, it is no longer a personal tragedy. It is merely an execution of a predetermined plan. It is a known variable. This is not pessimism. This is proactive realism. By accepting the worst, you free your mind to focus solely on the best response. The market doesn't care about your hope. It only respects your preparation. But preparing for the outcome is only half the battle. To truly achieve consistency, you must confront the single greatest lie that keeps intermediate traders trapped. The lie that you control the outcome. This brings us to Principle 1, the dichotomy of control. This is the hardest truth to swallow because it requires the death of the ego, and the ego thrives on the illusion of control. You, the struggling intermediate trader, fundamentally believe you control your P and L. You believe that if you analyze harder, study more indicators, or find the perfect entry time, you will force the market to yield the profit you deserve. When the market doesn't comply, you feel betrayed, angry, or victimized. The dichotomy of control, taught by Epictetus, clearly separates the world into two categories: things we control and things we do not control. In trading, this line is razor sharp, yet almost universally ignored. You control your entry, you control your position sizing, you control where you place your stop loss, you control your decision to exit. These are internal acts of will and discipline. You absolutely do not control the price movement. You do not control the news event. You do not control the liquidity provider's algorithm. You do not control the collective actions of billions of dollars moving through the system. The price is an external event, a consequence of forces far larger than your account. When you try to control the external, when you stare at the chart and try to mentally will the candle higher, or when you move your stop loss because you believe you can dictate the price's trajectory, you are crossing the line. You are attempting the impossible. And here is the psychological trap. Every ounce of energy you spend trying to control the uncontrollable is energy stolen from controlling the controllable. Revenge trading is the perfect example. The price moved against you, uncontrollable. You feel angry, internal, controllable. Instead of managing your internal state, you try to control the price again by immediately entering a larger position, controllable action directed at an uncontrollable outcome. You lose your discipline because you lost sight of your sphere of influence. The truly consistent trader understands they are not a price predictor. They are a risk manager. Their job is not to be right. Their job is to execute their defined edge flawlessly, knowing that the edge is only realized over a large sample size. Think of yourself as a sailor. You control the trim of the sail and the rudder. You control the timing of your maneuvers. You do not control the wind. The wind is the market. A master sailor doesn't rage at the wind. He adjusts his sails to navigate the conditions he is given. Your P and L is the result of the wind and your sailing skill combined. You cannot control the wind, but you can perfect your skill. This realization is devastating to the ego, but liberating to the mind. Once you fully accept that the price is external and uncontrollable, the emotional attachment to the outcome vanishes. You are free to focus 100% of your mental capital on execution and risk management, the only two things that actually determine your longevity. This leads us directly to the second principle, which is how you process the inevitable failure that comes from operating in an uncontrollable environment. Principle 2. Amor fati, love your fate. This is perhaps the most radical Stoic principle, and it is essential for stripping the emotional sting from a losing trade. Most traders merely tolerate a loss. They begrudgingly accept the stop-out, grumbling, "Well, that's just the cost of doing business." But deep down, they feel cheated. They feel like the loss is a setback, a punishment, or a failure of intellect. Amor fati demands more than tolerance. It demands embrace. It demands that you not only accept the loss, but that you love it. Why would you love a losing trade? Because the loss, the stop-out, the market moving against you, that is the fate of that specific trade. And that fate is providing you with absolutely essential data. A loss is not an enemy. It is the tuition fee for the lesson you just received. If you treat the loss as a personal insult, you throw the lesson away and seek revenge. If you treat the loss as necessary data, as a confirmation of market conditions, as a test of your discipline, or as a necessary cleansing of overconfidence, then the loss transforms from a negative event into a positive piece of information. The market is never wrong. Only your interpretation is. When you internalize amor fati, the loss stops being a reflection of your worth and starts being a reflection of market structure. It becomes emotionally neutral. It simply is. This neutral perspective is what allows you to review your journal honestly. You are not reviewing a painful failure. You are reviewing a data point. You are not asking, why did I fail? You are asking, what did the market do here, and how does this data refine my edge for the next trade? The trader who loves his fate is immune to the emotional roller coaster of P and L. He is grateful for the profit because it validates his edge. He is grateful for the loss because it sharpens his focus. Both outcomes are merely inputs into the overall system. These three principles, premeditatio malorum, to inoculate the mind, the dichotomy of control, to define your power, and amor fati, to neutralize the emotional response to failure, form the bedrock. They create the mental fortress necessary to trade without ego. But simply removing the emotional sting of a loss is not enough. The market is not just testing your patience, it is testing your perspective. And the final step in building this foundation is understanding that time, patience, and the ability to do absolutely nothing are your most valuable assets. We call this next principle, the principle of memento mori, and it is the key to unlocking true, unshakable trading patience. We call this next principle the principle of memento mori, and it is the key to unlocking true, unshakable trading patience. Memento mori. Remember that you will die. In trading, this translates to, remember that your edge is temporary. Remember that your current success is fleeting. Remember that your recent win means precisely nothing about your next trade. The ego loves the victory lap. You hit your target. You banked a significant gain, and immediately, the ego whispers, you are better than the system. You are smarter than the market. You deserve more. This is the psychological moment of maximum danger. This is why most intermediate traders blow up their accounts not after a string of losses, but immediately following their biggest win. They forget the impermanence of fortune. They confuse a successful outcome with permanent skill, and they overleverage the next entry, believing their judgment is now infallible. Memento mori forces radical humility. It reminds you that the market does not grant tenure. Your skill must be proven anew on every single chart, every hour of every day. The moment you feel invincible, the moment you feel entitled to the profit, is the moment you have forgotten the essential truth of the craft. The market is indifferent to your history. Your job is not to ride the high of the last win. Your job is to return to zero, emotionally, mentally, before the next execution. The market is a constant, churning cycle of birth and decay. Setups die, trends reverse, strategies lose relevance. If you cling to the memory of yesterday's success, you will miss the shifting reality of today's price action. This principle is the antidote to hubris. It demands that you treat every successful trade as a gift, not a guarantee. It demands that you immediately scale back your risk after a significant gain, locking in the emotional capital and resetting the psychological state. If you cannot do this, if you allow the recent win to inflate your position size, you are not trading your strategy. You are trading your ego's need for validation. That feeling of invincibility? It's the moment the market has you. The path to consistency is paved not with massive, aggressive wins, but with the steady, almost boring application of process. Memento mori teaches you that if you want to survive long enough to reach mastery, you must treat your account like a precious, finite resource that must be defended fiercely from your own inflated sense of self. This leads us directly into the fifth principle, which is about defending the only true asset you possess, your mind. We call this Principle 5, The inner citadel. The inner citadel is your fortress. It is the protected space where your strategy lives, where your rules are enforced, and where decisions are made based on objective reality, not mass hysteria. The modern market is an information war designed specifically to breach your citadel walls. Every headline, every analyst downgrade, every hyperbolic tweet from a so-called guru is a weapon aimed at your emotional stability. Ask yourself, how often do you deviate from a perfectly valid setup because some talking head on television suggested a recession was imminent? How often do you chase a move because you saw a screenshot of someone else's massive gain on social media? The intermediate trader is addicted to external validation and external noise. You believe that more information equals a better edge. This is a profound and costly delusion. More information often equals less clarity. It dilutes your focus and introduces variables that are completely outside your control and, crucially, outside your tested strategy parameters. If your system is sound, it should not require CNBC to confirm its validity. If your edge is real, it should not be dependent on the latest earnings rumor. The market already discounts all public information. By the time the news reaches your screen, the price move has already happened. Chasing the news is the definition of trading lag. The inner citadel demands strict filtration. You must become ruthless about what you allow to enter your mental space. If the information does not directly contribute to the execution of your predefined plan, if it only serves to create fear, uncertainty, or doubt, it must be discarded immediately. The ego hates this isolation. The ego wants to be part of the collective narrative. It wants to feel smart by knowing the inside scoop. But the true trading edge is found in the silence after you shut down the noise. Your profitability is inversely proportional to your exposure to external commentary. The Stoics taught that the only true freedom is the freedom to choose your response to external events. In trading, the only true freedom is the ability to execute your plan perfectly, regardless of the chaos surrounding you. If you allow the noise to dictate your entries or exits, you have surrendered control of your inner citadel. You are no longer the sovereign decision-maker. You are a reactive participant in someone else's fear trade. Shut it down. Turn off the noise. The market speaks in charts, not headlines. The moment you realize that the most important chart you must manage is the one in your own mind, you are ready for the hardest psychological shift of all. This is Principle 6, Virtue as the Only Good. This principle fundamentally redefines what winning means. For the vast majority of traders, success is defined exclusively by the profit and loss statement. If the account balance goes up, the trade was successful. If the account balance goes down, the trade was a failure. This attachment to the outcome is the root of most trading suffering and the primary fuel for the ego. The ego demands immediate financial validation. It demands that the universe reward its effort with cash. Virtue, as the only good, flips this scorecard entirely. In trading, virtue is defined as the perfect execution of your predefined process. It is the consistent application of your rules, regardless of the outcome. Under this principle, if you followed your entry criteria precisely, managed the risk according to your written plan, and exited exactly where your system dictated, even if the trade resulted in a maximum loss, that trade was a success. It was a virtuous act. Conversely, if you panicked, entered too large, moved your stop loss because of fear, and then accidentally made money because the market bailed you out, that trade was a failure. It was a vicious act, one that severely damaged your long-term consistency. The ego cannot stand this separation. It screams, "But I made money. How can it be a failure?" Because the goal of trading is not to make money on one trade. The goal is to survive long enough and execute well enough over a series of hundreds of trades to allow your statistical edge to play out. If you reward random, rule-breaking behavior with positive reinforcement profit, you are teaching yourself to be a terrible, inconsistent trader. You are training yourself to rely on luck, and luck is not an edge. The external scorecard, the P and L, is merely feedback on the quality of your edge within the current market environment. It is not feedback on the quality of your character or the quality of your execution. Your focus must shift entirely to the internal scorecard. Did I honor my stop loss? Did I stick to my position sizing? Did I wait for my confirmation signal? If the answer to those questions is yes, then you have won, irrespective of the dollar amount. You have won the internal battle against fear and greed, and that is the only victory that compounds over time. This radical detachment from the financial outcome is the ultimate weapon against entitlement. You are not entitled to profit simply because you risked capital. You are only entitled to the consequences of your perfect execution. By prioritizing virtue, you strip the ego of its primary source of power, the need for financial affirmation. You are trading not for money, but for mastery. You are trading to prove your discipline, not your intelligence. But redefining success is only half the battle. What happens when you execute perfectly, follow every rule, and still face a prolonged, brutal drawdown? What happens when the market takes back months of hard-won progress? This is where the ego mounts its final, most devastating attack, and it is the subject of the next principle. Amor fati, the love of fate. Amor fati, the love of your fate. It sounds poetic, perhaps even passive, but in trading, it is the highest form of active resilience. You cannot truly love the result, whether it is profit or loss, until you neutralize the devastating emotional power that the outcome holds over you. This brings us directly to Principle 7, indifference to externals. The Stoics referred to things outside our sphere of complete control as adiaphora, indifferent things. They are tools, utilities, or circumstances, but they are not measures of your character or your worth. Your health is an external. Your reputation is an external. And crucially, your P and L is an external. Most intermediate traders treat their account balance like a moral scorecard. A green day validates their genius. A red day confirms their deepest fear of inadequacy. They have made the money an extension of their identity. When the market takes the money, the ego perceives it not as a statistical fluctuation, but as a personal attack, a judgment on their intelligence. This is why a simple 2% loss can trigger a 10% revenge trade. You are not trying to recover capital. You are trying to recover self-esteem. This is the hidden stage of trading, confusing competence with outcome. You believe that if you are truly good, the market must reward you immediately and consistently. When it doesn't, you feel betrayed, and betrayal leads to emotional, rule-breaking volatility. Your goal must be to rationally detach. Money is fuel. It is a necessary tool for the profession, but it is not the definition of the professional. When you view money as an adiaphora, you create a necessary psychological distance. You can look at a devastating drawdown, a 15% hit to the account, and analyze it with the cold, clear logic of a surgeon rather than the panic of a victim. The loss is regrettable, but it is not catastrophic to yourself. The market is chaotic. It will pay you when it is ready, not when you deserve it. Your job is to make sure your capital is available when the opportunity finally aligns with your edge. If you let the outcome define your emotional state, you will always be swinging between manic euphoria and paralyzing fear, ensuring that you are never ready for the actual opportunity. The true currency of a professional trader is not dollars, it is focus. But if the market outcome is indifferent, where do you anchor your confidence? If you cannot look at a winning trade and feel validated, what is left? This leads us to Principle 8, self-sufficiency. In the early stages of trading, confidence is purely external. It is built on hot streaks. You hit 5 winners in a row, and you feel invincible. This is the most dangerous kind of confidence, because it is borrowed. It is conditional. The moment the market shifts and you hit 2 losers, that confidence evaporates, leaving behind a brittle, toxic arrogance that demands the next trade must be the hero trade. Self-sufficiency means removing the need for external validation entirely. Your confidence must be derived solely from internal consistency. Ask yourself, did I follow the rules I set for myself? Did I quantify my risk? Did I execute the entry and the exit according to the plan, even when my gut screamed otherwise? If the answer to those questions is yes, then that day was a successful day, regardless of the color of the P&L. This is the hardest shift to make because our brains are wired for immediate reward. We seek the dopamine hit of the confirmed win, but the professional trader seeks the quiet, understated satisfaction of procedural integrity. They seek the boring, repetitive adherence to a statistical edge. Self-sufficiency is the realization that your edge is statistical, not magical. It works over hundreds of trades, not 3. You don't need the market to tell you you're smart. You already know your process works because you have back-tested it, modeled it, and sized it appropriately. When you are self-sufficient, a losing day does not send you scrambling to find a new strategy or follow a new guru. It simply means this instance fell into the negative side of the expected distribution curve. You trust the curve more than you trust the momentary pain. The greatest traders are often the most self-sufficient people because they have learned that relying on a chaotic external system for emotional stability is insanity. They are the same person, the same measured, disciplined executor. On a day they make 5 figures, and on a day they lose 4 figures. Their internal state is consistent. The market cannot break a man who defines his success by his actions, not his results. But even with this internal consistency, there are moments when the cumulative pressure feels unbearable. The drawdown that lasts 6 weeks, the trade setup that worked perfectly 5 times but failed spectacularly on the 6th, wiping out the gains of the previous 5. This is when the ego, desperate to reclaim its sense of control, begins to catastrophize. It tells you, this is the end. You are a failure. You will never recover this. To combat this emotional hijacking, we turn to Principle 9, the view from above. This is a powerful cognitive tool used to neutralize the immediate, overwhelming emotional impact of a setback. When you are staring at a screen, your world shrinks to the current candle, the current loss, the current moment of panic. The view from above is the radical act of zooming out. Imagine you are looking down from a satellite. You see your city, your street, your house. You see the tiny desk where you are trading. Now zoom out further. You see the continent, the Earth, the solar system, the galaxy. Where is that 5% drawdown now? It is less than a speck of dust. This perspective is not meant to diminish the value of the capital or the seriousness of your profession. It is meant to diminish the value of your emotional reaction to the setback. Catastrophizing is the ego's way of making itself the center of the universe. It tries to convince you that this momentary pain is the defining moment of your life. The view from above reminds you that this loss is simply a statistical event occurring within a massive, complex system of capital flows, all happening over a geological timescale. Your trading career is a marathon. A drawdown is a kilometer marker where you had to stop for water. It is not the finish line. When you feel the panic rising, ask yourself, in 5 years, how will I remember this Tuesday? Will this specific loss be the thing that defines my entire journey? The answer is almost certainly no. It will be a lesson, a data point, an expense paid for education. This principle is about neutralizing emotional drama. Drama requires a spotlight, and the view from above turns the spotlight off, forcing you to see the reality of your situation. You are alive, your methodology is intact, and the market will open again tomorrow. You simply need to adjust your risk and move forward. The cumulative effect of these 3 principles, indifference, self-sufficiency, and perspective, is the creation of an emotional firewall. You have trained your mind to treat the market not as an adversary that must be defeated, but as a probability machine that must be managed. You are no longer reacting to the noise, you are responding to the data. You have built the emotional endurance required to survive the long, brutal stretches that break 90% of traders. You have learned to love the process, not the payoff. But this raises the final, most essential question. If we become indifferent to the money, self-sufficient in our process, and calm in our perspective, what happens to the inherent primal fear that still remains? The fear of losing everything. The fear that whispers, even when you follow the rules perfectly, that the next trade will be the one that finally proves you wrong. That fear never truly goes away. It only changes its disguise, and learning to harness that fear, to make it a tool, not a tyrant, is the subject of our final and most difficult principle. This is Principle 10, the ultimate paradox of surrender. The Stoics called it sympathia, the recognition of interconnectedness, the profound truth that everything is one system. For the intermediate trader who is still fighting the market, this principle requires the greatest internal shift. It means accepting that the market is not something happening to you, but something you are a part of. Your P and L is simply a reading on a dynamic system, not a moral judgment on your worth or intelligence. But what do we do instead? We fight. We treat the market like an enemy we must conquer. We enter the trade with the desperate, arrogant belief that our analysis must be superior to the collective wisdom of every other participant. We are a single drop of water trying to stop the ocean. This resistance, this internal friction against the reality of the price action, is the root of all trading suffering. You are fighting the tide, and the tide does not care about your conviction or the hours you spent backtesting. You look at a chart, you see a setup, you click the button, and when the price moves against you, it feels like a personal insult. It's not the loss of capital that truly burns. It's the immediate, undeniable proof that your perception was flawed. Your ego demands to be the smartest person in the room. It demands validation. It screams, "I saw this, I was right." And when the market humbles you, the pain of being wrong triggers a cascade of psychological defense mechanisms. Revenge trading, averaging down, widening the stop to avoid realizing the error. These aren't financial errors. These are ego-driven panic attacks disguised as market decisions. The market is not judging you. It is merely reflecting back the quality of your internal discipline. It is the ultimate indifferent mirror. Surrender, in the context of sympathia, does not mean giving up. It means giving up the illusion of control. It means accepting that the market has perfect, absolute mastery over the immediate future. You are a passenger on a train you cannot steer. Your mastery lies not in predicting the next curve, but in managing your own conduct while the journey unfolds. Can you maintain your stop-loss even when your gut screams that the turn is coming? Can you take the profit even when the greed whispers of 10 more points? When you truly surrender the need to be right, you stop asking, "Why is the market doing this to me?" and start asking, "What is the market doing, and how must my rules require me to respond?" The market does not care about your technical analysis. It simply is. Your suffering is manufactured in the gap between what you want the market to do and what the market is doing. Close that gap, and the suffering ends. Here is the paradox that dismantles the ego instantly. You achieve self-mastery precisely at the moment you acknowledge the market's total mastery. The need to be right is the anchor that drags your performance down. When you detach your self-worth from the outcome of the next tick, something profound shifts. The trade becomes purely procedural. It's no longer a battle for validation. It's just the execution of a strategy with known, acceptable risk. This is the moment when the pressure vanishes. This is the quiet confidence that the best traders possess. They are not fighting the market, they are flowing with it. They have accepted the ultimate truth. The market is already perfect in its chaotic, random movements. Your analysis, your conviction, your hope, they are all irrelevant until the position is closed. Think about the moment you enter a trade. Is there a knot in your stomach? That knot is your ego, demanding a favorable outcome. When you apply sympathia, that knot dissolves. You are entering the trade knowing, absolutely knowing, that the market owes you nothing. You are simply placing a bet based on probabilities that favor you slightly over time, and you have already paid the cost of the loss in your mind before the trade is active. This is the death of the trading ego. It doesn't die in a fiery confrontation. It dies quietly, through irrelevance. If you are not fighting the market cannot defeat you. It can only take your capital, which you have already budgeted for. The suffering ends when resistance ends. The chaos of the market is external. The discipline of your mind is internal. You cannot control the former, but you are absolutely sovereign over the latter. When you operate from this state of surrender, your focus shifts entirely. You stop obsessing over the entry price of the current trade and start obsessing over the integrity of your overall system. You stop seeing losses as failures and start seeing them as necessary data points required to prove the statistical validity of your edge. The market is not your opponent. It is your ultimate, unbiased teacher. Every loss is a lesson in probabilities. Every win is a confirmation of patience. Sympathia allows you to see the larger structure, the long game, because the noise of the immediate P and L no longer dominates your perception. You become less emotional because you are no longer making it about you. You are making it about the reliable execution of a reliable process. You stop trying to force the market to validate your intelligence, and you simply allow the edge to express itself over time. This is the path to true, sustainable consistency. The market does not reward conviction, it rewards preparation and detachment. The true master trader is the one who steps back and realizes they are merely an observer and an executor, not a controller. They are the disciplined technician who understands that their job is only to manage risk and press the buttons when the system dictates, regardless of how they feel about the outcome. They have already accepted the loss. They have already accepted the possibility of being wrong. We have walked through 10 difficult, essential principles, from the dichotomy of control to this final paradox of surrender. We have systematically stripped away the layers of ego, fear, and impatience that keep 90% of traders perpetually stuck in that intermediate, painful stage. The goal was never to teach you how to analyze a chart better. The goal was to teach you how to analyze yourself better. Because when the ego is irrelevant, when the need to be right is gone, the only thing left is pure, disciplined execution. You are free. You have acknowledged the market's mastery, and in doing so, you have finally achieved your own. But understanding these principles philosophically is the easy part. The difficult work starts now. How do we take these 10 mental models and forge them into an unbreakable daily ritual? How do you transition from intellectual knowledge to automatic, profitable habit? How do you ensure that when the pressure hits, you default to discipline, not panic? The answer lies in mastering the one component we haven't yet discussed, the hidden framework that transforms psychological insight into financial edge. That framework is what we must discuss next. The framework isn't complicated, it's ancient, it's the daily rep. You have internalized the theory of Stoicism, the acceptance of what you cannot control, the focus on virtue, execution quality, and the rejection of emotional slavery. But knowledge without application is debt. The market is not a library, it is a gym. You need mental reps, and the most critical rep happens after the market closes. This is the Stoic evening review. It is not a review of your P&L. That number is irrelevant to your growth. That number is the outcome you cannot control. You are judging yourself. You are auditing your character, not your strategy. You must sit down when the adrenaline is gone and ask the hard questions. Did I execute the plan, or did I execute my fear? Where did impatience force my hand? When did greed make me hold past the target? This isn't just abstract reflection. You are mapping the precise moments the ego hijacked the controls. You are identifying the emotional trigger, the sudden spike of anxiety that led to an early exit, the rush of false confidence that led to overleveraging. You cannot defeat an enemy you haven't mapped, and the evening review is your reconnaissance mission into the terrain of your own self-sabotage. If you perform this disciplined introspection every single day, you create an accountability partner that never lies to you, your past self. But cleaning up yesterday's mistakes is only half the battle. The morning rep prepares you for today's inevitable chaos. Before the bell rings, before the noise starts, before liquidity kicks in, you must rehearse failure. This is the Stoic technique of premeditatio malorum. You are not manifesting loss. You are accepting the possibility of loss. You are inoculating yourself against surprise. Repeat the mantra until it settles deep into your nervous system. Today, I accept randomness. I accept that the outcome of this trade is outside my control. My only control is the quality of my entry and exit. If you can genuinely say that, if you can feel the weight of that acceptance, you have disarmed your ego before the fight even begins. The ego thrives on expectation and certainty. Acceptance starves it. Journaling, in this context, transforms from a simple log into a profound Stoic exercise. It isn't just logging trades, it's logging pre-trade emotional states. Before you click the button, write down the feeling. Am I trading out of boredom? Am I chasing yesterday's win? Am I trying to prove something to the market or to myself? These quiet moments of recognition are where the ego is exposed. You catch it in the act of demanding action, demanding validation. If you can see the ego urging you to intervene, you can choose inaction. Inaction, paradoxically, is often the most profitable decision you can make. It is the mastery of self-restraint. The integration of these three rituals, the evening review, the morning mantra, and the pre-trade journal, creates a psychological fortress. You are using the market as a tool for self-mastery, not just a source of income. You are building automatic discipline. But even the strongest fortress needs a final, unbreachable defense. There is one principle, the 10th and final principle, that ties all this together. It is the hardest to accept, yet the most essential for permanent profitability. It's the final surrender. The final surrender isn't the white flag of defeat. It is the ultimate act of psychological victory. It is surrendering the need to control the uncontrollable, which is the immediate outcome of any single trade. When you finally internalize these 9 principles, the acceptance of loss as tuition, the separation of outcome from process, the focus on the controllable input, you stop fighting the reality of the price action. Your resilience is no longer a choice you have to force. It becomes the default operating system. You are no longer trading against the market. You are trading with its inherent chaos, using the structure of your system as a raft. What happens then is profound. Your decision-making sharpens instantly. You minimize discretionary errors, not because you try harder, but because the emotional noise that fueled those errors is finally gone. The ego, that loud, demanding client inside your head, has been silenced. It cannot panic sell, it cannot revenge trade, because it has no stake in the immediate P and L. It only cares about the objective execution of the plan. This mechanical, almost boring precision is the definitive hallmark of objective trading. That is the transformation. You finally realize the chart isn't the challenge. The volatility isn't the problem. The only variable you ever truly needed to master was the person sitting in the chair. Self-mastery isn't just an advantage in trading, it is the only sustainable edge. Indicators fail. Strategies eventually become public domain. But the disciplined mind, the one that sees a 5-figure drawdown and still executes the next setup precisely, that remains proprietary. That is your unshakable foundation. We have defined the terms of this psychological fortress. We have covered the 9 pillars that build automatic discipline. But there is always a final test, a final crucial realization that separates the permanently profitable from the perpetually stuck. It is the principle that forces you to confront the ultimate lie you tell yourself every day you sit down at the screen. It is the final acceptance of responsibility for everything that happens, good and bad. So, are you willing to fully accept that the market owes you nothing, and that your greatest enemy isn't volatility, but the desperate need to be right? If you are ready for that ultimate confrontation, if you are ready to finally kill the last vestiges of your trading ego, then you are ready for the 10th principle, the principle that makes all the previous 9 unbreakable. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message. and you let me know this work is not in vain.